around this issue. This is the fourth installment, like I mentioned. The previous webinars have been on the topics of insurance pricing, captives, and insurance fraud. And the recordings of all of these, if you missed them the first time around, are available in our NAIC library catalog. You can find these by going to library.naic.org. Our expert speakers today are Jim Hilliard from Temple University, Dennis Burke from the Reinsurance Association of America, and Commissioner Scott White of the Virginia Bureau of Insurance. We will have, at the end of our session today, some time for Q&A, and Frank Tomasello of the Institute's Griffith Foundation will be moderating that for us. If you have questions along the way, please feel free to put those in the chat, and we will get to as many of them as we can. There's also a link to the slides and the materials in the chat, so feel free to take advantage of those. We'll post a recording of this webinar at the same link later today or tomorrow when that's available. Finally, at the end of today's webinar, we will provide a link to a very brief survey also in the chat box. And we'd appreciate it if you took about 3 minutes to give us some feedback on today's session. That helps us to create additional webinars to fit the needs and wishes of our audience. So with that, I'm going to turn it over to our first speaker, Professor Jim Hilliard.
Thank you. And Erin, you were sharing the slides, right? Here we go. So thank you for attending this afternoon. I'm looking forward to talking with you about reinsurance. I have a couple of different topics. One, the first one I'll actually talk about is where reinsurance comes from and how it's sort of developed over the centuries. And then I'm going to talk about some of the reasons why insurance companies might use reinsurance. And then I'm going to talk about what has happened, what some of the mechanics of reinsurance are, some of the terminology that you might hear, and then look at some pricing data over time before we pass it on to Dennis and Scott. Move forward to the next slide. Because this is the Griffith Foundation presentation, we're going to keep our comments and contributions unbiased and purely educational, in keeping with the Griffith's nonprofit, nonpartisan, non-advocative organization educational mission. One of the things that I really enjoy having a liberal arts undergraduate background is to bring some of the literature and history into the world of business and insurance. And one of the things that's really striking to me is this line from the very first scene of The Merchant of Venice. It's a play that Shakespeare wrote that's come under some fire because of some anti-Semitism claims, but it's still a really interesting and fun play to explore how human nature works. In the very first scene, Antony, who is the Merchant of Venice, is really upset, and his friends are trying to figure out why that's true. And so they come up with all sorts of reasons why he might be upset, including that his love interest has departed him, or that all of his, he's concerned about all of his goods being on ships across the sea. And Antony's response to that, he says that my ventures are not in one bottom trusted, nor to one place, nor is my whole estate upon the fortune of this present year. Therefore, my merchandise makes me not sad. In this context, Shakespeare used the term bottom as another word for ship. Antony's kind of saying at this point that he's well diversified. And because he's well diversified, he's not as concerned about his merchandise as he is whatever else it is that's causing him trouble. We'll go to the next slide. We'll come back to this idea in a few minutes. One of the things that comes from my liberal arts background, I actually took a full year of biblical Hebrew, and part of my job in that course was to translate the Joseph narrative. And in the Joseph narrative, Joseph interprets a couple of dreams that the Pharaoh of Egypt had, and those dreams really pointed to the fact that Pharaoh's dreams were predicting 7 years of plenty followed by 7 years of famine. This is a pictograph from inside of the tomb of Mena in Thebes. It's said to have originated around the second millennia before the Common Era. But the idea here is that there were times of plenty and there were times of want. And we still see those obviously today in some parts of the world, although our agricultural technology has resolved a lot of those issues. The thought here is that risk management really began with the idea of taking advantage of times when you had plenty, planting grain that could be stored and storing it for times of want. And that was what Joseph, in the biblical narrative at least, was hired on to do, to sort of manage the taxation of the plenty so that there would be plenty to have left over in times of want. And the story is much more rich than that, but I look at it from the perspective of an introduction to risk management going way back 3 or 4 centuries before the Common Era. Let's go on to the next slide and we'll take a look at what's happened more recently. Coming along to the Middle Ages, financial instruments like derivatives simply meaning an asset whose value is derived from the value of another asset. They were used to finance war and military actions, including the Crusades, sort of carrying imperialism through the Near East and the Western Europe. Derivatives became a part of Dutch auctions. If you've heard about the tulip frenzy in the 1600s, a lot of that frenzy was not about tulips themselves, but was about futures on tulips. And so we see these derivatives sort of being used to settle cash and giving rise to put and call options. All of these things were taking place as we sort of came along to see a small coffee shop near the coast of England in London, where news and information was spread about the different dispositions of shipping enterprises. And that was a coffee shop called Lloyd's of London. Lloyd's of London has a really fantastic history, and I had the chance to visit Lloyd's a few years ago. At Lloyd's of London, they still have a bell that has been rung since about the 18th century whenever a ship sunk or there was some international news. That bell is not in great repair, and it hasn't been used very often, most recently for royal births and deaths and things like that. But Lloyd's is now an international broker house for unique insurance contracts, including reinsurance. But it got started basically with the owner of Lloyd's Tavern, or Lloyd's Coffee House, putting together a newsletter basically saying, here are different ships that are looking for financial backing. And so this woodcut here is intended to represent what Lloyd's might have looked like in the 17th century. And it gave rise to this sort of diversification. And it also gave rise to the term that we now know as underwriter, because the investor and the ship owner would come together to a contract. And at the bottom of the contract, the investor would sign their name, underwriting the entire contract. So this is some language that we still see in the insurance industry that comes out of this sort of beginning of using insurance strategies or shared investment in single ventures to sort of facilitate trade. And that continued and brought us into the Industrial Revolution, where a lot more concentration of capital was happening and more needs for diversification. Let's move on to the next slide and talk about how that impacts reinsurance. Reinsurance came about in the middle of the 19th century, primarily in Europe. Some big reinsurance companies, names that you'll still recognize, like Cologne Re and Swiss Re and Munich Re. This reinsurance boom was fueled by urban fires in London and Hamburg and Glarus in Switzerland. And the reinsurance boom was a way for insurance companies to diversify the top level of their losses and to get international capital to come in and share some of those losses. And then it expanded to life insurance in the later 19th century. And it goes back even prior to the Revolutionary War in the United States with some challenges. But what was key to the growth of reinsurance in the United States was when the New York State Supreme Court ruled that reinsurance indemnified the insurer, but not the ultimate insured. And that clarified the contractual language and gave rise to the use of foreign reinsurers admitted into the US business just before the turn of the 20th century. Let's go on from here. Reinsurance provided stability that allowed primary insurers to survive major events of the early 20th century, like the San Francisco fire, the sinking of the Titanic, events happening in World War II, and more something that's come back into our news obviously recently, the 1918 Spanish flu pandemic. And during World War II, global reinsurance became concentrated in countries that were not engaged in the battles, which is what has given Swiss Re dominance in the industry, which I think we'll see later on in the presentations today. Our next slide, please. So I'm going to shift now from the history of reinsurance, which is obviously a very small sketch, and I'll refer you to an excellent book, the Against the Gods. The name of the author escapes me at the moment, but Against the Gods gives you a lot of insight and interesting information about the history and rise of insurance and diversification overall. But as we look into the academic literature and what insurance companies are looking for when they are using reinsurance, there are a lot of things that they're looking for, but I think that we can really kind of focus them around these 4 topics. The first is tax arbitrage. The second is the use of reinsurance as a capital substitute. The third is earnings smoothing, which can generate more stability in terms of stock price, and real services efficiencies. I'll talk about each one of these in turn, but on the next slide, we'll see what tax arbitrage has to do with it. There's some literature, essentially Myers and Smith from the Journal of Business in the 1980s, that focuses on the nonlinear tax code as a driving reason why some companies might use insurance rather than to finance their losses, say with equity issues or debt issues or things like that. And in reality, we found little evidence that companies use reinsurance because of the nonlinear tax code. However, reinsurance provides a unique kink that gives us opportunities, a kink in the tax code that gives us opportunities to take advantage of differential tax rates. And so we find that a lot of reinsurers are domiciled in states and territories and countries where they enjoy a different tax rate than primary insurers do. We see, for example, that the Cayman Islands and Bermuda and Vermont provide special tax advantages to reinsurers, which means that the primary insurer, who would normally pay taxes on their income, can shift some of that burden over to reinsurers who have a lower tax rate. And therefore, that tax sheltered relationship between the reinsurer and the state or the domicile where they're located means that the premiums are taxed at a different rate, and that tax position can be an advantage to the primary insurer, usually not alone as the primary reason, but as a key indicator of what some opportunities are. So the primary insurer expenses the reinsurance premiums before they pay tax. That means they get a tax break where they are, and the reinsurance may allow them to increase their capacity, which is something that we're going to come to in the next slide, which we'll move on to now. A capital substitute. Commissioner White confirms to me that yes, one of the primary regulatory tasks is to maintain the insurance industry solvency. So some of that in the news right now around banking solvency, but we're going to focus on insurance today. Therefore, the regulator provides and imposes minimum risk-based capital requirements. And usually that happens at the state level, meaning that in order for an insurer to be licensed to write insurance in a particular state, they have to satisfy the regulatory capital requirements and maintain a sufficient amount of equity capital. And that excess capital is held essentially by the insurance company in cash and low yield securities while waiting for a massive event to happen. And those low returns limit the amount of investment profit, especially in low return regimes, which we've seen recently, although we're sort of moving into a bit of a higher return on low yield securities. It's still not to the point where we can generate the kind of profit that insurance investors require. That means that there may be an opportunity, when the regulator permits it, to shift some of that burden to reinsurers who have more diversification opportunities, who can sell their capital and issue other types of securities, including catastrophe bonds and other contingent securities, into the international capital markets, where there may be a lot more capacity, allowing reinsurers to substitute reinsurance for the capital that they might otherwise have to hold. And combined with the tax relief that they get from the tax arbitrage, this may provide additional relief for capital costs, reducing capital costs for insurers and increasing the opportunity to generate profits for their investors, which will then bring us to the next topic, which is earnings smoothing. As a pure finance person, I typically think about earnings smoothing as kind of a fool's errand, but that's in the theoretical world where lots of things are held constant that aren't actually true. But as we move into a world where we have to validate the manager's ability to do and say the right things, earnings smoothing becomes a proxy for information that the manager might or might not actually have. And so when we're concerned about shocks to insurance companies, earnings smoothing can be an important part of maintaining a stable environment for investors to know what to expect. In particular, when losses could be highly correlated, common weather conditions that impact property losses, heavy traffic or road conditions, legal standards from state to state that may drive up liability claims, earthquakes, floods, hurricanes, those kinds of highly correlated loss events can impose an earnings shock on an insurer. And if an insurance company has reinsurance put in place to handle some portion of that overall loss, or at least to take away the extreme tail, then that can stabilize earnings. That can impact managerial compensation, opportunities for managers to take advantage of their own contingent compensation based on firm performance. And it can also improve corporate bond ratings, generating lower cost of capital. So even though in theory, I might say that earnings smoothing is a fool's errand, there are lots of ways in which it can actually align incentives between managers and shareholders in a productive way. And then importantly, if we think about the fact that if an insurance company suffers a major loss after a flood or an earthquake, it might be difficult for them to go to the capital markets at that point to replenish their capital supply. And so earnings smoothing can be important there. Another important reason that reinsurance can become important is that reinsurers have real services efficiency in some cases. If we go to the next slide, I'll talk about what that means. It may be value added for a reinsurer to have specialty claims handling capacity in the case of catastrophic events, that a reinsurer actually has flood response, hurricane wind response, earthquake response type claim staff on hand, or the ability to retain that claim staff in an emergency. That's something that insurers might be willing to pay extra for the ability to access that special claims handling capacity after an event. That's on the back end, but on the front end, reinsurers have a huge incentive to invest in advanced risk modeling and analytical models to help them improve peak pricing to generate more business. And so more and more primary insurers are relying on reinsurers' risk modeling technologies to help them price their business the right way in the first place. Now, some work that I've had the chance to work on academically is to take a look at the persistency of reinsurance contracts from carrier to carrier. And what we find is that the more frequently a primary insurer renews business with a reinsurer, the more stability we can assure in the marketplace. The lower the level of information asymmetry, the lower the level of moral hazard. And so the amount of premium and the profits can increase the more frequently we renew. So all these four things, the tax arbitrage, the capital substitute, the real services efficiencies, and the increased capacity of reinsurers to underwrite business gives us four key reasons why reinsurance might be an important thing. I only have a few minutes left, but I did want to talk about some key reinsurance terms. I'll go through these real quickly so that we can get on to Dennis's comments. Some terms you might see and to look at reinsurance as facultative, treaty, pro rata, excess of loss, and rate on line. I'll move through these pretty quickly, talking about facultative on the next slide. Essentially, facultative is a case-by-case reinsurance policy where a single risk is shared between a primary insurer and a reinsurer. The primary insurer raises up this portfolio of losses. The reinsurer can accept it or refuse that case-by-case risk, and they can choose. The primary insurer can choose which risks they want to cede. So if there are certain risks that they have a higher level of confidence in, the tail of that risk, they can decide not to cede that. Where if they have another risk where they're more concerned or have less confidence in what the tail looks like, that might be one that they can cede. We'll go to the next slide and talk about. So here we see different risks within this particular building. Fire, theft, wind, those could be one facultative case. We'll go to the next image here. Liability, we could cede any or all of these cases, but it comes down to the specific insured. I think we have one less graphic on this slide, which talks about workers' comp being another risk and so the primary insurer can choose which of these risks they want to cede. The reinsurer can accept or refuse any of them, but it's a case-by-case basis. I think we have the next slide now. Treaty or obligatory is where the primary insurer cedes some or all of their portfolio. Once they've ceded that portfolio, the reinsurer cannot refuse. The primary insurer cannot pick and choose which they are going to cede. These are typically automatically renewed and used for a large portfolio of similar risks. The next one, I think we go to pro rata. Next slide. Pro rata is where the reinsurer covers a specified percentage of incurred losses. The premium is based on a percentage of primary premiums written. They can come in two ways. One is quota share, where premiums and losses are both allocated according to proportion. These are best for risk profiles where everything looks the same and really ideal for capital relief. Then we have surplus reinsurance, where the reinsurer charges a risk-based premium, but is focused on handling losses above a specific retention point. And it's used to limit tail risk rather than to share risk overall. Next slide, please. Non-proportional is where reinsurers cover all losses above a specific attachment point. Sometimes this is called excess of loss or catastrophe, maybe based on a single risk or a portfolio of risks. Stop loss insurance covers all losses by an insurer above a specific amount or deductible. It's usually limited to very large losses where losses exceed primary premiums and expenses. And one last term that I want to look at, which is rate on line. This is a measure of reinsurance pricing. It's not a type of reinsurance, but it's a measure of the relative reinsurance cost. We calculate it simply by taking the premium paid divided by the limit. And this time series chart goes back to 1990 and shows us what that rate on line trend has been. It's measured by Guy Carpenter. We see in 1992 that there's a spike in rate on line. That's right around the time of the Northridge earthquake and Hurricane Andrew. This drops and quite steadily over the next several years. We see a little jump up around 2001 when there was some uncertainty in the market around catastrophe terrorism reinsurance. 2007, 2008, where we see the Katrina, Rita, Wilma, a lot of hurricane activity. Tails off after that, but we see now since COVID, we see the rate on line jumping up again. And so we're seeing reinsurance prices rise. Part of that is also in coordination with rising interest rates and returns that we see in the marketplace. So that concludes my comments with regard to the origins and some of the terms of reinsurance. I'm going to pass it back to Frank now, and he'll introduce our next speaker.
Professor Jim Hilliard, thank you very much. Appreciate the exploration and the overview of the origins, the mechanics, the evolution of reinsurance. Want to turn things over to our next speaker in just a moment, but first, a reminder to all attending remotely. We'll devote the final 10 minutes or so of our session to question and answer. And you may submit questions for our panelists. You can do that via the WebEx Q&A feature. I will review all incoming questions and will address as many as time permits. With that, it's a great pleasure to welcome to our microphones Mr. Dennis Burke, Vice President of State Relations for the Reinsurance Association of America. Dennis, building upon all that Jim Hilliard has shared, we welcome your discussion of the current reinsurance market. Lots of ground to cover, to be sure, and limited time to do so. So where, sir, would you like to begin?
Well, I'd like to begin by saying thank you both for the invitation to participate and for the promotion. While I may have a Juris Doctorate, I don't have a PhD, and I do have a friend who calls me Dr. Burke all the time, so that, you know, I'll tell him that I got a promotion. Next slide, please. My presentation is, admittedly limited because of the 20 minutes. If you want a deeper dive into reinsurance claims, underwriting, finance, catastrophe management, and related issues, the RAA provides seminars for a fee on those issues, and we also occasionally do seminars for individual states to explain reinsurance in a much more narrow sense, but longer than 20 minutes. From this slide, the most important thing is that reinsurance is a contract. It's a voluntary transaction, although for solvency purposes, based upon the book of business that a particular company may be writing, the aggregate limits that it's written are of such a nature that it's essentially mandatory to help it achieve its necessary risk-based capital scoring. And the contract is between the reinsurer, and there's a whole variety of names for reinsurers and insurers or cedents and ceding companies, some of which have a French origin, some of which are, the the English euphemisms, but basically the reinsurance contract indemnifies the ceding insurer or the original insured for the losses that it has paid under its policies, and it's paid, so that's the concept of indemnifying, and it's subject to the terms of the contract. Next slide. So reinsurance is a form of insurance. All of the parties are licensed in some jurisdiction. They're sophisticated parties, so there's less consumer protection other than in terms of the solvency of the original reinsurer. So the parties are free to enter into a contract as they see fit. And as I said before, it's an indemnity contract, and we'll move on to the next slide. So the kinds of reinsurance, which the doctor was kind enough to discuss previously, we have the treaty reinsurance, which is the class of insurance that is in the contract and written by the insurer. From a reinsurance perspective, you're actually underwriting the insurance company, its ability to select risks, price risks, and to handle the claims. Then there's the facultative reinsurance, which is, as the doctor previously stated, it's a risk by risk underwriting. And frequently the facultative risks are the more unique risks and large risks that you reinsure separately to protect your treaty and to protect the reinsurers, because the reinsurance relationship, when it is a true, sharing and handshake agreement was something they had said previously. It's an informal partnership between the reinsurers who are capital providers and the ceding insurer. So you want to protect that relationship to the extent possible, because you get better results and better treatment from the reinsurer in the treaty if you don't have aberrational losses in it. Moving on to the next slide. And as previously discussed, there are a variety of contracts. The proportional surplus share was mentioned earlier. That is largely a property type transaction. It's much more complicated. It's not as relevant. There really is a significant trust between the companies. It's very relevant for those people who have entered into it. But from a beginning to reinsurance perspective, the quota share is easier to understand. Then there's the excess of loss contracts, and as was stated, there's a variety of categories of those and types of those. So we'll move on. So this is just a simplistic, notwithstanding the fact that it's a busy slide, simplistic analysis or graphic presentation of the types of contracts that can exist. So there's the quota share or the surplus share, and then there's and each risk excess of loss. So you can have aggregates, you can have a variety of catastrophe contracts, which is a lot of people are aware of, and then there's aggregate excess of loss, not to be confused with per risk aggregate excess of loss. They're way too complicated to get into, but the reality is each and every line of insurance can have a variety of these. So there can be a multitude, and there frequently are a multitude of reinsurance contracts that a ceding insurer may have. So one thing that is useful, we'll move on before we get there. So here's a high level note about reinsurance contracts. We jokingly say, if you've seen one reinsurance contract, you've seen one reinsurance contract. They're all unique. Terms that you've seen elsewhere can be defined in a way that is different than you've seen. Contracts can change from year to year. So there really is a need to read each and every contract. Now, what is let's assume you're a regulator and you're trying to examine an insurance company. One of the things you could do is go to the accounting department and you ask them for their little handy reinsurance cheat sheet, which is how they cede and assume the reinsurance. That is, how does the premium flow? When does the reinsurance come? How does the claims transaction apply? And by using that, you can compare that to the actual wording of the contract and see if it makes sense. The accounting department tends to have an understanding of what they intended to achieve in the contract, and you just see if that aligns with the actual contract wording. Next slide, please. So from regulatory perspective, reinsurers are insurers. They're regulated for solvency in their domestic jurisdiction. And some of those domestic jurisdictions are not in the United States. There are also the concept of, I believe catastrophe bonds was mentioned. There's a concept of a special purpose reinsurance vehicle, or an SPRV, and a catastrophe bond is that. So it's a complicated transaction, but it's a public offering of a security and it may be a privately placed public offering, but it's an SEC transaction. And then the funds raised from the sale of that bond are used to fund a reinsurance transaction that is fully collateralized. And typically these are, placed out of a country such as Bermuda that has a flexible enough regulatory regime that it can turn around these transactions quickly. So the reinsurers are regulated in their own jurisdictions for their solvency. Typically, there's no rate of form regulation. There are things such as solvency clauses and submission to jurisdiction. So there is some direct regulation over the contract, but most of the regulation of reinsurance is indirect. It is regulation of the reinsurer through obligations that the ceding company has pursuant to the laws and regulations of its domestic regulator. Next slide. So the rate online index that was shown previously is useful, because if you go back, you will see that major events have traditionally been the things that have changed the reinsurance market, whether they're wars, which resulted in the formation of a U.S. reinsurance market, since the trading partners were on the opposite side of the war, or whether it's a major event that depletes capital, and the capital markets investors thought that it would be appropriate to invest anew because they believed there would be a chance for rate increases and profits. So insurers and reinsurers will sometimes raise capital through stock issuance. There have been, and Bermuda has been a notable jurisdiction for these new reinsurance formations after an event. There are catastrophe bonds, which are basically single-use reinsurers. There was the advent of sidecars. Sidecars came about during an interesting legal period involving a former Attorney General of the New York State, and those issues prevented many insurers and reinsurers from going directly into the capital markets and doing a public transaction. So they did a more private placed transaction with capital investors, and the sidecar is a reinsurance company that is formed to take a share of a particular insurer or reinsurer's book of business. So the reinsurer is essentially bolted on to the to the insurance company or reinsurance company, and that's why it got the nickname sidecar. And the financial crisis, which led to a close to zero interest rate environment for a period of time, left investors looking for risk that could provide them with a return that was better than the return they could get elsewhere. And there was also a hope that the reinsurance transactions would provide diversification, because at least as far as we know, wind and earth movement are not related to the capital bonds and capital other capital markets. So that didn't entirely work out well, because sometimes uncorrelated things happen at the same time. Move on to the next slide. So this is a disclaimer because we're moving towards issues that are potentially forward-leaning, and that the RA and its members are subject to antitrust and competition laws in the various states, the United States, and internationally. So we don't seek or obtain forward-looking market information from our members. We do read voraciously to see what our members are saying, what analysts are saying, what investors are saying, and that provides us with a very good view of the market. The remaining comments in this presentation are mine. They are not the RAA's official comments, and they're based upon reported information and or investor comments that were made in public at seminars, including the recent RAA catastrophe modeling seminar. Next slide. So, as I said, there have been a variety of losses of late. So, to step back, insurance and reinsurance are fundamentally based on the premise that bad things do not happen to all people at the same time. That's the idea of diversifying risk in your book of business. Catastrophes run contrary to the diversification because there's correlation between the parties, and reinsurance is frequently used to help with catastrophe exposure. The problem is that at least in the past 5-6 years, there has been an increase in the frequency of severe events. So there are a variety of severe events that are on this slide. Multiple hurricanes in 2017, combined with the largest wildfires in 30 years, and severe convective storms continually, and there seem to be a plethora of tornadoes, hailstorms, and thunderstorms that are creating significant losses. Derechos is a term that most of us had not heard until within the last decade, and there have been some very expensive derechos. There was a winter storm in Texas that was named by the Weather Channel Uri. Winter Storm Uri created a problem for the Texas insurance grid. Electrical grid, and the electrical grid failed, which resulted in pipes freezing in buildings, and pipes freezing tend to burst, and burst pipes are not a problem while they stay frozen. They become a problem when they thaw. When they thaw, there was significant water damage, which resulted in very significant losses for the consumers as well as the insurance and reinsurance industry. So the takeaway from all of this is that while bad things don't happen to everyone at the same time, sometimes they happen, in close proximity and more frequently than people had planned. As a result of that, reinsurers, investors have told the insurers that they're not meeting their expectations. So you're not 5 out of 6 years, reinsurers have failed to provide their investors with a risk adequate rate of return. And quite frankly, it's been relatively anemic. And then reinsurers will sometimes reinsure themselves. And there's a French term called retrocession. And the reinsurer, when it does that, is called a retrocessionaire. And the market in which you place a retrocession is called the retrocessional market. So there is a variety, as I said earlier, a variety of names that are used. And in those markets, both in the reinsurance and retrocessional markets, there had been covers for aggregate losses that met the terms of the contract, which were, let's say, property catastrophe losses over a variety of issues that would cover hurricanes as well as earthquakes, tropical storms that are not named hurricanes, wildfires, etc. Well, the plethora of losses were such that the retrocessional reinsurers had more risks than they had anticipated, and hence have largely revamped that market. So that's had an impact on the ability of reinsurers to manage their own aggregate risk through the placement of a retrocessional cover. Next line. And at the same time, there are other economic factors. So when there are losses that impact catastrophe bonds, those losses are paid by drawing down on the collateral. The capital markets investors typically make a commitment to invest in a catastrophe bond for a 3-year period. To the extent there is a long tail in certain states like Florida, or traditionally has been. Florida's made some changes to that, or it happens towards the end of the 3-year period. The untapped collateral is held onto by the ceding insurer to cover adverse claims development, and the retrocessional or reinsurer cat bond reinsurer was hoping to get that money back and to reinvest it in some other way, take their losses, brush themselves off and go back and take their money. Maybe they'll invest it in a catastrophe bond. Maybe they'll invest it in another capital markets opportunity, but they're unable to get that capital back. So that capital cannot be deployed. So that reduces the trapped capital, reduces the capital that's available to write more reinsurance. Inflation. So there's the inflation that you and I all feel. There's the changes in interest rates by the Federal Reserve, et cetera. And then there's the inflation that relates to insurance. So in the catastrophe section, construction inflation has been 20% a year for the past several years. That's way above the consumer price index. The causes of that are increases in wages and the availability of employees to handle catastrophe rebuilding after the fact, as well as inflation in the cost of construction materials, some of which was exacerbated by the COVID pandemic. Then there is the actual interest rate increases. When the Federal Reserve was trying to slow inflation, it sent the markets a message that interest rates needed to go higher. The capital markets have settled on their particular interest rate expectations, and that interest rate expectation has an implication in GAAP as well as statutory accounting, where bonds that were issued at a lower interest rate lose value in a rising interest rate environment. And the accounting market rules result in a surplus hit to insurers and reinsurers. As a result of that surplus hit, insurers have significantly lower surplus in certain circumstances, as do reinsurers. One reinsurer, a notable name, as a result of losses, some currency exchange risks, as well as mark-to-market, lost 50% of its statutory surplus. So we'll move on to the next slide. So here's the question. This was actually asked by an investor at our catastrophe modeling seminar. Do reinsurers know what they're doing, and can they make money? And they're saying, is this really a change, or is this just aberrational? Do you not know? Is climate change affecting the frequency of severity? Is this just the fact that we don't have the full historic record? And either way, do insurers and reinsurers, are they contemplating those issues? So that's the question. As a result of that, we're in a market where the insurers and reinsurers face different expectations at January 1 of this year, and reinsurance rates went up. And that is whether that continues and how long is a question yet to be decided. With that, I'll turn it back to Frank.
Thank you, Dennis. Appreciate the insightful discussion there. Quick reminder that folks may submit questions for our panelists using the Q&A feature. We'll devote some time to addressing those. But first, let us turn to Virginia Commissioner Scott White, who's with us to share his perspective on reinsurance through the regulatory lens. Commissioner, thank you for being with us. The floor is yours.
Very good. Thanks, Frank. And I've enjoyed listening to Jim and Dennis talk about reinsurance. The boring piece of it, the regulatory requirements, is left to me. I'll try to keep it brief. I know we're running out of time. There's just a couple of central points I want to make. The first one is that, as touched on, I think, by Jim, the U.S. system, we take a direct and indirect approach in terms of how we regulate reinsurance. So when we're talking about direct regulation, that relates to the solvency supervision of U.S.-based reinsurance companies. If you're based in the U.S. And you're a reinsurance company, you're going to be regulated in the same fashion as our traditional insurance companies. And as with that, what we're talking about is performing, licensing, financial examinations, and the ongoing solvency supervision of, again, U.S.-based reinsurance companies. But really, it's the indirect regulation of reinsurance that occupies most of our attention, because a significant portion of the risk ceded by U.S. domiciled companies goes to reinsurers domiciled outside of the U.S., and they're known as alien reinsurers. So, how is that done? Again, it was touched on before. The main vehicle is through a statutory credit for reinsurance. Credit for reinsurance, what does that mean? It's really an asset or a reduction from liability that a ceding company, again, the company that's ceding its risk to the reinsurer, can record in its financial statements for that business that was transferred via reinsurance. Again, the main takeaway here is that we as regulators are focused on the ceding company that might be looking at the reinsurance arrangements or specific provisions in the agreements to some degree. But from our perspective, our overriding concern is the solvency of the ceding company, the impact of the reinsurance on the ceding company's financial condition, and again, ultimately, the financial impact on consumers of the products sold by the ceding company. So I mentioned, the offshore or alien reinsurers, but we're talking about many of the largest, oldest, financially strongest reinsurance companies who are located abroad. Think of, Bermuda that was mentioned, Lloyd's was mentioned. The capacity the reinsurers based in these companies provide is critical to U.S. ceding companies. But again, these offshore reinsurance, they're effectively beyond the reach of U.S. regulation. Our statutory accounting rules and laws regarding credit for reinsurance have historically required, because of that, all amounts recoverable from what we call unauthorized reinsurers must be properly collateralized. This is done either through a letter of credit issued by a qualified U.S. financial institution or else a trust account established in the country for the benefit of U.S. seeding insurers. So, what I want to close on is kind of the evolution of this critical concept of collateralization being necessary in order to take that credit. There are requirements that have to be met for that to occur on the part of the reinsurer. They have to be licensed in a particular state, submit to that state's jurisdiction and examination authority, file annual statements. They have to maintain a minimum level of policyholder surplus of at least $20 million, or else they're considered unauthorized. But the story for the past 10, 15 years has been kind of a whittling away of the collateralization requirements, beginning back in 2011, when changes were made to our model law and regulation. It basically allowed the companies reinsurers to reduce these requirements if they met certain conditions. They would be deemed certified reinsurers operating in qualified jurisdiction. But the real game changer was in 2017, a covered agreement between the Treasury and the European Union, and then the following year, UK, as a result of Brexit. The primary change from this covered agreement was the total elimination of collateral for reinsurers, again, in these jurisdictions, if they met certain solvency and capital requirements. We changed our model law and regulation, and there was a 5-year period for all the states and territories to adopt those in their own jurisdictions. It had to be done by September 1st, 2022. We actually were able to accomplish that in order to avoid preemption. So that was a big accomplishment. And then we also have, within those changes, we created reciprocal jurisdiction status to countries or jurisdictions that did not sign a covered agreement. So where we are today, I'll just close. We have a list of approved reciprocal jurisdictions, being the EU and UK that I mentioned. We've also added Bermuda, Japan, and Switzerland, not part of the covered agreements, but they met that process included in our law and regulation. So right now we have 55 reciprocal jurisdiction reinsurers approved at this point. And I would say all processes are operating as were intended and designed. So with that, Frank, I'm going to turn it back over to you.
Commissioner, I thank you very much. We also thank you, Dennis Burke, and Jim Hilliard for the presentations. In the time that remains, a bit of Q&A for all. A couple of notes first, hearkening back to your comments, Jim Hilliard, and I see noted in the chat screen you shared the author of the book that you recommended, Against the Gods, The Remarkable Story of Risk, authored by Peter L. Bernstein. So we thank you for that. And along those lines, for policymakers with us today interested in learning more about reinsurance, I open this up for the three of you. Where else might they turn to delve more deeply? Appreciate your thoughts on that to sort of get our Q&A started here.
Frank, I would say that one of the greatest websites for understanding what's going on in the reinsurance industry is artemis.bm, a Bermuda site. There's a lot of information about reinsurance and catastrophe bonds and securitization, deal by deal index on securitization, including tranching and expected losses and interest rates. Something I go through with my students every semester to sort of give them an idea of where trends are in terms of triggers and returns and things like that. So that's artemis.bm as one source. The others may have others as well.
I would mention, go ahead, Dennis.
No, go ahead, Commissioner.
Well, I just mentioned I had a meeting earlier today with the Society of Actuaries, and they indicated they have a reinsurance program that they put on for any state that would like. So I know they've done it in our state in the past few years, and I would encourage any regulators or states that want to take advantage of that to do so.
In addition to the RAA programs, the NAIC website really provides some good information, background on the regulatory issues that, particularly the ones that Commissioner White had mentioned. There's a very digestible webinar series that is put on by the French reinsurer, the state reinsurer. I think it's CCR. I forget exactly what it is, and it's in English. So it provides just a little lunchtime continuing education that you won't get CE credit for, but it's quite good.
Appreciate the insight there. Want to transition to a question submitted from a member of our audience asking about what it is that leads to the, at least in their view, the prevalence of non-U.S. reinsurers here in the U.S. market. Is that driven by issues of taxation, regulation, perhaps other factors? Appreciate your thoughts there, panelists.
Well, I can start and then maybe turn it over to Dennis. I think that's a good question. For one, I don't know if there's a single right answer. I think there are a variety of reasons why you might see this. We're seeing it more and more in a particular area in the life industry. We're focusing at the NAIC on private equity-backed life insurance companies as part of their investment strategy to cede a large percentage of their business to jurisdictions like Bermuda, for example, or the Caymans, where we know there are certain tax advantages that I think were mentioned earlier. And also, again, as I mentioned in my presentation, they're subject to different statutory accounting rules, capital and reserving requirements that may be advantageous to them as opposed to the same rules that apply in our very conservative financial solvency system here in the U.S.
Thank you, Commissioner. Gentlemen, your reaction, Jim, Dennis?
No, I think the Commissioner is right. One thing that I would add is, and I believe I referenced it earlier, is the Bermuda Commissioner, the Bermuda Monetary Authority, which is the regulatory body there, is relatively flexible and quick in approving the speed to market that the business people want to achieve. The Commissioner's comments about private equity is something that needs to be fleshed out to ensure that there's appropriate solvency protection for the ultimate U.S. cedents and consumers, and that's an issue that we understand that the Bermuda market is trying to be responsive to. And then the Bermuda market is also an equivalent jurisdiction under the EU scheme of Solvency II regulation, so it's easier for them to transact insurance on a cross-border basis, and we are still in quibbling with the EU over the equivalency or the substantial similarity between our system and theirs, and ours performed quite well in the solvency problems after the capital crisis, and theirs not so much. But for some reason, they were relying upon models that didn't always work. But they believe they're right, and that's just the reality that we have to deal with. Plus, they're historically the Europeans were very active in the reinsurance industry, so they continue to be so.
Thank you,
Dennis. That from a historical perspective, it's less true now, but it's still true at some level that access to capital in other domiciles is important too. Currency translation and other restrictions against about who can invest where, and the availability of capital in other places, looking for exposure to risk and diversification. Less an issue than it used to be, but it's still there.
Thank you, Jim. Appreciate it. We are nearly out of time. I do want to sneak in a final question here, if I may. A member of the audience asks for your views, your assessment, as it were, of the risk to reinsurers from climate risk. And our participant sort of notes the notion that experience there is very limited. My assumption is that our attendee is sort of referring to this fairly recent and significant increase in frequency and severity, sort of from a cat loss perspective. Appreciate your thoughts there. What does that mean for reinsurers? How does the risk profile change?
Well, the risk profile may change. The near-term situation has largely affected earnings and not really capital positions enough, and there is solvency, and solvency should not be a concern near term, particularly since contracts are largely annual renewed contracts, so there is an opportunity to adapt. The issue is longer term, and there's also the investment transition risk. But I don't think that becomes a real significant factor until we can throw the switch and have electricity without fossil fuels. So, but I think longer term, the issue is how do the insurance and reinsurance markets adapt to a changing environment? And I think society needs to do its part as well, and we need to adapt via mitigation defenses. Perhaps not everybody can build everywhere they want because it's now below the high water mark. So there's a variety of things that may happen, and we largely have the time to adapt to them, but the built environment may not.
Thank you, Dennis. So, gentlemen, any closing comments or additional color you wish to add there?
I
All
realized
right,
that I forgot to end my presentation with a description of what happened at the end of Merchant of Venice, and that was that Anthony, all of his ships finally did come in, and everything was resolved well at the end.
Well, we thank you for that bookend, Professor Jim Hilliard. It's been a fascinating 60-minute conversation. On behalf of the NAIC Center for Insurance Policy and Research and the Institute's Griffith Insurance Education Foundation, I thank you, our panelists, Professor James Hilliard of Temple University, Mr. Dennis Burke of the Reinsurance Association of America, and Commissioner Scott White of Virginia. Thank you very much for sharing your insight and expertise. A couple of quick notes. We invite all attendees of today's session to take just a moment to provide feedback. You may do that by completing a very brief anonymous program survey. Simply click on the link that appears in the chat box to access that survey. Your input is important to both the CIPR and the Institute's Griffith Foundation. Today's program will be available for on-demand playback in the days ahead, posted to our respective home pages. With that, on behalf of Aaron Campbell and the team at the NAIC's CIPR, and all of us here at the Institute's Griffith Insurance Education Foundation, I'm Frank Tomasello. Thank you for joining us. We bid you a pleasant good afternoon.
Thank you.